Hi everyone. As we approach year-end, this is the perfect time to assess whether your portfolio has both rebalancing engines working for you. One of you just dropped a comment that exposed something most dividend channels completely ignore: the real secret behind how SCHD and SCHY actually grow your dividends. A UK viewer wrote, "Much of SCHD's past dividend growth has come from selling stocks that have gone up and replacing them with higher yielding stocks. If capital growth slows, this cycling will slow. If my analysis is correct, dividend growth at SCHY will improve as capital growth allows recycling of stocks to increase income." This is genius. Here's what nobody wants to admit. SCHD's legendary dividend growth isn't just from companies raising dividends. A massive portion comes from the rebalancing engine, selling appreciated stocks and rotating into higher yielding replacements. And in 2025, that engine completely flipped. SCHD's capital appreciation has been modest at roughly 1.5 to 2.8% year-to-date through October, limiting its rebalancing power. Meanwhile, SCHY surged approximately 24%, supercharging ITS dividend growth engine. Let me show you the hidden mechanism that makes these ETFs work and why understanding this changes everything. The rebalancing engine, the secret nobody explains. Here's what most investors miss. When SCHD's Q1 2025 dividend payment increased 22% versus Q1 2024, everyone assumes it's purely from organic company dividend raises. Wrong. A significant portion comes from what I call the rebalancing engine. Step 1, SCHD holds 103 quality dividend stocks that appreciate at different rates. Step 2, at annual March reconstitution, SCHD sells appreciated stocks that now yield lower percentages. Step 3, SCHD replaces them with new stocks, having higher current yields. Step 4, the fund's overall yield increases mechanically. SCHD's 19.2% turnover in March 2025 wasn't random. It sold 17 stocks and added 20 new ones. That turnover is the feature driving dividend growth. But here's the killer insight. This engine only works when the fund has capital gains to harvest. When prices stagnate, the rebalancing mechanism loses fuel. The 2025 proof: when one engine idles, the other roars. Look at what happened in 2025. SCHD's performance: capital appreciation 1.5 to 2.8% year-to-date through October. Q1 2025 dividend up 22.16% versus Q1 2024, paid $0.2488 per share. Q2 2025 dividend down 5.28% versus Q2 2024. March 2025 reconstitution, 19.2% portfolio turnover, 20 additions, 17 deletions. That Q2 dividend decline wasn't because companies stopped raising dividends. SCHD's rebalancing engine lost power. Without substantial capital gains, fewer appreciated stocks existed to rotate into higher yielders. SCHY's performance: capital appreciation, approximately 24% year-to-date through October. Same 10-plus year dividend payment requirement as SCHD. Same quality screening methodology. Massive rebalancing fuel for future reconstitutions. SCHY's strong appreciation means its rebalancing engine is supercharged. It can sell appreciated international stocks and rotate into higher-yielding quality companies, mechanically increasing dividends. The three mechanisms of dividend growth. Dividend ETFs grow payouts through three mechanisms. Mechanism number 1, organic company dividend increases, companies raising dividends 5 to 10% annually. Real growth, but only one piece of the puzzle. Mechanism number 2, the rebalancing engine, the hidden driver. The fund sells appreciated, lower-yielding stocks and replaces them with higher-yielding quality stocks. The fund's dividend grows even though individual companies may not have changed payouts. This requires capital appreciation to work. Mechanism number 3, dividend reinvestment compounding. Reinvested dividends buy more shares. More shares generate more income. Compounds beautifully over decades. Most investors only see mechanism 1. Smart investors understand all three. In 2025, SCHY dominates mechanism number 2, while SCHD's temporarily idles. Why SCHD's March 2025 reconstitution tells the story. SCHD's March 2025 reconstitution showed the limitation. What SCHD added: ConocoPhillips, now top holding at 4.37%, Merck, Target, General Mills, Total 20 stocks added. What SCHD removed? Pfizer, BlackRock, multiple regional banks. Total of 17 stocks removed. The challenge? Limited capital appreciation meant SCHD couldn't execute aggressive rotations into significantly higher yielding stocks. The result? Mechanical dividend growth through rebalancing slowed in Q2. The SCHY advantage right now. SCHY is positioned perfectly for 2026 and beyond. Advantage number 1, fresh capital gains to harvest 24% appreciation means substantial rebalancing fuel for future reconstitutions. Advantage number 2, international stocks at different economic cycles, European utilities, Asian conglomerates, and Australian resources operate on different cycles than US companies, creating rotation opportunities SCHD cannot access. Advantage number 3, lower international valuations. International dividend aristocrats often trade at lower valuations than US equivalents, higher yields for identical quality. Advantage number 4, currency diversification. Weak dollar periods amplify international returns, creating additional capital gains to harvest. The truth? You need both engines. When US value stocks outperform, like 2021 to 2023, SCHD's rebalancing engine dominates. SCHD delivers superior mechanical dividend growth. SCHY's engine idles when international markets outperform, like 2025. SCHY's rebalancing engine dominates. SCHY delivers superior mechanical dividend growth through future reconstitutions. SCHD's engine idles. Owning both captures rebalancing advantages regardless of which geography leads. You're not betting on one region. You're betting on the mechanism working somewhere globally. Your 3-tier strategy. Tier 1, the cyclical opportunist tilt toward whichever fund has rebalancing momentum. SCHD outperforming. 65% SCHD, 35% SCHY. SCHY outperforming, 35% SCHD, 65% SCHY. Rebalance every 6 to 12 months based on relative performance. Tier 2, the balanced mechanist equal 50-50 split and maintain it. Captures rebalancing wherever it works. Combined yield approximately 3.70%. Tier 3, US core with international insurance, 70 to 75% SCHD, 25 to 30% SCHY. SCHD remains foundation with international protection. Combined yield approximately 3.75%. The data proving this is real. Statistic number 1, SCHD's Q1 2025 dividend increased 22.16% year over year, driven by March reconstitution rebalancing. Statistic number 2, SCHD's March 2025 reconstitution swapped 19.2% of holdings. Statistic number 3, SCHY's approximately 24% year-to-date return provides significantly more rebalancing fuel than SCHD's 1.5 to 2.8%. Statistic number 4, both require 10-plus consecutive years of dividends, identical quality, different geographies. Statistic number 5, SCHY costs 0.08% versus SCHD's 0.06%, just $2 per $10,000 for international access. Statistic number 6, together they provide rebalancing across 235-plus quality dividend companies globally. Statistic number 7, SCHD has delivered approximately 12.4% annualized returns since 2011, proving the mechanism works over full cycles. The uncomfortable reality. SCHD remains phenomenal. Its 12% plus annualized return since 2011 proves the rebalancing mechanism delivers over complete market cycles. But 2025 exposed the limitation. The engine needs fuel. When capital appreciation slows, mechanical dividend growth diminishes. Not because companies fail, but because rotation opportunities vanish. SCHY gives you the same mechanism working internationally. When one geography stagnates, the other provides fuel. Your action plan. Month 1. Assess your rebalancing exposure. If you only own SCHD, you have zero international rebalancing access. Determine your target allocation. 50-50, 60-40, or 70-30. Month 2. Add SCHY using new money. Don't sell SCHD. Its long-term track record is too strong. Enable dividend reinvestment on both funds. Dollar cost average if investing large sums. Quarter 1. Monitor which fund outperforms to understand where rebalancing momentum exists. Rebalance only if one fund drifts 10% plus from your target allocation. Dividend growth depends on capital appreciation, fueling the rebalancing engine. When fuel disappears, mechanical growth slows. SCHY isn't better than SCHD. They are complementary engines working at different times based on which markets appreciate. Start today. Keep SCHD as your proven foundation. Add SCHY at 22 to 50% of your dividend allocation. Let global rebalancing engines work for you. Build unstoppable dividend growth regardless of market leadership. The investors who understand this rebalancing secret will dominate in any environment. Don't bet on just one geography's engine. Own both engines, maximize growth, win every cycle. This is educational content only, not financial advice. Past performance doesn't guarantee future results. Consult a financial advisor before making investment decisions. SCHD and SCHY, two rebalancing engines, global dividends, one unstoppable strategy. Please like, share, and subscribe. Here's to understanding the real mechanisms behind dividend growth and profitable investing.